Hello and welcome to another episode of Transforming Business with me, Marvin Schneider, where I talk about the whys, the wherefores, the tools, the technologies, the understanding, and the call to action to transform the global business and investment community to create wealth on an ongoing basis in ways that enhance the well-being of the individual, the wider community, and the environment. And those last three aspects, enhancing the well-being of the individual, the wider community, and the environment, is going to become or represent the paradigm shift that we're currently going through. And my core proposition, and it's a very simple proposition, is that in the long run, in any sustainable way, the only way to create wealth on an ongoing basis is if you do enhance the well-being of the individual, the wider community, and the environment. And at this point, I'm not seeking to make the case that that is true. There's going to be a certain number of people listening to this or watching this that will intuitively, innately get the idea. And of course, there's going to be quite a few people that will resist the idea that there is no role for any sort of concern for stakeholders outside of shareholders, because that's the old paradigm. It's what's called the shareholder primacy paradigm, popularized by the thinking of Milton Friedman and the Chicago School of Economics. And that has become the dominant business paradigm for about the last 50 odd years or so. And the practical reality is that it is neither sustainable or in any way ethical, the behaviors when taken to the common practice of how you execute the idea of profit maximization, and particularly fairly short-term profit maximization, with the view that that's in the best interest of shareholders. And through the course of this podcast series, I'll slowly make the case and lay out the understanding where I'm hoping that a reasonable chunk of people fairly quickly will have that aha moment and say, yes, of course, that's true. Or what I'm saying is true is what I'm saying. Um, that's the way I think it's going to work. And then as and when more and more people come on board to the idea, and we have boards and CEOs and senior executives in large corporations, both listed corporations and privately owned corporations, once they start getting on board, it'll build a snowball of momentum. And then, quite frankly, those that resist and hold out, to the last will probably fall by the wayside. And, as unfortunate as that is, and as much as I'm trying to give every board member, every CEO, every senior executive an opportunity to come on board, I think the practical reality is that there will be a fairly large rump that will resist. And then I think what we're going to be seeing is that they're just going to become irrelevant. Their career will sort of just wither on the vine. And then, a new generation of business leaders will take over and drive the mantle forward. So I suspect that's the way it's going to work. But if you're in the camp of an early recognizer of the truth that I'm laying out and are willing to become an early adopter, particularly a board chair or a CEO, or even best, the combination of those, please get in contact with me, because it's important that we start the momentum moving, and it will build. And then later on, I'm going to lay out some of the work that I'm doing to build a global ecosystem of individuals and organizations to lead this global transformation effort, but that'll come in a couple of episodes' time. So in the last two episodes, I've laid out some of the more technical aspects of understanding corporate performance from an economic point of view, not an accounting point of view, the fundamentals of business valuation, and how wealth creation is a reflection of increasing the value of the firm beyond that which it was already expected to increase. And in particular, what I laid out in the previous 2 episodes of this podcast series is the linkage between strategy and what the board and the executive team is doing and needs to do, that links that strategy and those actions to the value of the firm, and how the change in strategy and improvement in strategy leads to wealth creation in a fundamental sense. And so that's where I'm focused at the moment, the actions of the board and the executives to deliberately and systematically drive the value of the firm beyond that which is what it was expected to be at various points in time, and in doing that create wealth. That's kind of what I've laid out in those previous 2 episodes. So I highly recommend that if you're just joining this podcast series, please subscribe to my YouTube channel. It's really easy to find. Jump onto YouTube, in the search bar, type in Valuation Insights, 2 words, Valuation Insights, and you'll find my YouTube channel. It's a brand new channel. We're slowly building a subscriber base. So please subscribe. And there's a playlist that I've created called Transforming Business. And so you can start from the beginning, listen all the way through, and keep up to date with how the story is evolving and how I'm laying things out. So whereas the last 2 episodes were quite technical in the corporate finance aspects, in this episode, I want to bring it back up to a higher level, the boardroom level, the CEO agenda level, more on what needs to be done, not the corporate finance underpinnings of it. As important as the corporate finance underpinnings are, and I highly recommend that every board member, every CEO, every senior executive team member equip themselves with the understanding that I'm laying out around economic performance measurement, its linkage to value, and how that drives wealth creation and what needs to be done to create wealth. And I'm very happy to put together a boardroom briefing for your board members and your senior executive team to lay this out in a systematic way. It's really important. So before I get into the main topic of today's episode, let me just do a really quick recap of where we've been so far. And to do that, I am going to share some screens. So let me do that. Okay, so in the episode called The Fundamentals of Business Valuation, one of the first things I did is lay out the concept of economic profit as being a construction of the measuring the performance of the company, so the internal performance of the company, starting from the P&L balance sheet, so the financial accounts, culminating in an apex measure of performance called economic profit. And I highly recommend that you go back to that episode and arm yourself with the understanding of what economic profit is, how you measure it, and how it's a reflection of 2 things. One is economic profitability, which is the percentage measure of economic profit, and the other is the driver in the growth of equity, which is basically the capital contributed by shareholders or the other capital that hasn't been distributed to shareholders from retained earnings. So there are 2 important things that drive economic profit over time. One is economic profitability. Every now and then you'll hear me use the term returns, and then it's growth in equity, not growth in revenue, not growth in profit after tax, not growth in anything else other than growth in equity. That's really important. Okay, so that's what I was laying out on that slide. Then I laid out how economic profit can be used to measure the value of the firm that's linked to strategy. And again, I'm not going to go into detail in this episode, but go back to the Fundamentals of Business Valuation episode to understand how that all works. It's really important. And the important thing is that this valuation approach, which is a corollary of the discounted cash flow valuation approach or DCF valuation approach, here we're discounting an forecast or future economic profit stream. But the really important thing here is that we can think about and reflect the consequence of strategy and strategic position in terms of the economic profit performance expected to be delivered in the future, and particularly how the forces of competition will drive those economic profits back down to zero over a period of time called the Convergence Horizon. And so we can think about the value of the firm in terms of returns, growth in equity, and the length of the conversion horizon, or the length of time that that strategy will resist the forces of competition before returns and growth get driven down to sustainable levels. So those are really fundamentally important concepts that I would like every board member, every CEO, and every senior executive team member to understand: the linkage between strategy, the economic performance of the firm, and the value of the firm over time. Really important. I then sort of followed up by just demonstrating how we can think about returns over a forecast horizon, and then a level of growth in equity over that forecast horizon. Here I've just constructed a very simple scenario of some linear type arrangements, and then how the forces of competition drive returns down to zero, which is the safest assumption you can make, and how the forces of competition will drive growth back to sustainable levels over a period of time. And here, this convergence horizon I've reflected as 15 years beyond the forecast horizon. So then the valuation task is to think about how the linkage of strategy will drive returns, growth, and the length of that convergence horizon. And those are the fundamental aspects that reflect the value of the firm. The next thing that I did was I laid out the idea that wealth creation is what occurs as a result of deliberate, systematic, and deliberate actions by the executive team and supported by the board, to drive the value of the firm over time, beyond that which is expected as a result of doing things differently. And that's what wealth creation is, nothing else. That is the definition of wealth creation. So wealth creation is what, in a fundamental sense, wealth creation is what occurs as a result of a set of deliberate actions by the board and the executive team to drive the value of the firm higher than that which was expected at a given point in time. Then here's the kicker. I then introduced the idea that when you are looking to create wealth on an ongoing basis, right? So it's one thing to do it once. So here on the left-hand side, starting in 2021, so there was a strategy in 2021 that led to the value of the firm at about $1 billion. And in 2 years later, it's expected to be $1.2 billion. But if over those 2 years, between 2021 and 2023, there was a deliberate combination of strategic, growth, operational, and tactical actions that drive the value of the firm in 2023 to be higher than that which was expected, you have created wealth. And that's great. That's really important. But here we go. From 2023 onwards, if you want to create wealth again over the subsequent 2 years, you've got to repeat or put together a different, deliberate combination of strategic, growth, operational, and tactical actions. And so ongoing wealth creation is it's an effort and it requires a capability in an organization which is beyond, in my view, what one can observe in a lot of organizations, right? So creating wealth once is great, but you can't sit on your laurels, because those people, those shareholders that have bought into the firm at the new and higher value, having done a whole bunch of good things, in order to create wealth for the shareholders that bought in at this value, the board and the executives then need to do a bunch of things that, again, will cause the value of the firm to be greater than that which was expected at the point in time when the new shareholders bought in. And this cycle continues and continues. So when we talk about ongoing sustainable wealth creation, it really does require a deliberate combination of some really important capabilities. And so let me just quickly lay these out one more time. So in the center is board governance. And there's a great book. It's a bit academic, but there's a good book called Prosperity, written by Colin Meyer, who's an academic at the Said Business School in the UK. And one of his great lines, which I really liked, is that he wrote that the purpose of governance is the governance of purpose. And we're going to link, and that sentiment, by the way, is 100% consistent with where I've been going to talking about for the last sort of 2.5 odd decades. So board governance is really important. And I really want to emphasize that, in my view, the role of the board is to set the conditions for ongoing sustainable wealth creation. Now, in my view, having kicked around in a consulting sense for a number of decades, my sense of things is that at the moment, way too much of the board's time is spent on compliance and oversight. Now, I'm not saying that compliance and oversight is unimportant. That's not what I'm saying. It is important, but more important is that the board sets the condition, executed by the executive team, for the long-term success and of the organization, which forward-thinking boards will very quickly begin to recognize that the fundamental condition that they're trying to set for this success is ongoing sustainable wealth creation in ways that enhance the well-being of the individual, the wider community, and the environment. So the board has a really important leadership role to play here. I can't underestimate that enough. And so I really encourage anyone listening that is a board member, please get in contact with me. It's so important, because there's so much work to be done. But so from that board governance perspective, it has an important linkage into strategic management. And strategic management is all about designing and executing the strategic moves required to enhance the value of the firm beyond that which is expected. In other words, create wealth on an ongoing, sustainable way. And of course, that then needs to dovetail into operational effectiveness. On the other side of the coin, all of these really important, let's call them left brain, the hard science of corporate management, needs to be embedded within or woven within a culture and a leadership regime that is supportive of a highly attuned creativity and innovation capability. That's how this works. At the end of the day, ongoing wealth creation is all about creativity and innovation. You cannot create wealth on an ongoing basis without innovation, and particularly innovation at the product service level and then the production distribution level. So I previously also speculated where I would sort of position on a scorecard the aggregate of the organizations out there around the world. And I think I made the point in the previous episode that I I positioned board governance. I think I was generous in positioning board governance at a mid score between totally, inappropriate and ineffective to what is required in order to support this ongoing wealth creation. And I don't even talk about the right-hand side of this scorecard as being best practice, because at the moment, there, my view is that we do not observe in anything that could be described as best practice that which is required in order to drive ongoing wealth creation in ways that enhance the well-being of the individual, the wider community, and the environment. So yes, I'm being a bit of a tough taskmaster here, but I've got a very good sense as to what's required. And so it's kind of important that we understand where we currently sit. And I think I'm being generous by giving, most organizations a mid-level score on board governance, because my sense is that way too much of what goes on in the board is compliance and sort of, protecting your ass and reputation, board members' reputation as much as the firm's reputation. So look, I might be a little bit critical, but I think it's important that we understand where we're starting from. By and large, strategic management in most of the organizations that I observe, and then you can basically read between the lines through the annual reports and the various other filings and various other things. My sense is strategic management is way laggard of where it needs to be, needs to be. And there's a lot of work that I can help companies, corporations, to lift up their strategic management, strategic planning, and then ultimately strategic management capability. It's there's a lot of work to be done. My sense is that a lot of organizations have become very, very adept and very good at operational effectiveness. But the issue going forward is whether the business models, the systems, the processes, the supply chain arrangements. The question is whether the existing combination of those things will remain fit for purpose under the new paradigm. And we'll talk about a little bit of that some episodes down the track. My sense is that there is a lot of work to be done at the culture and leadership level and the innovation capability level. We're going to talk about some of that as well. So what I really want to talk about now is a systematic approach, a systematic and structured approach to large-scale business transformation and particularly ongoing wealth creation. So there's two things that we're going to be talking about here. One is the really big transformational work that needs to be done to rebalance the organization around enhancing the well-being of the individual, wider community, and the environment. There's a lot of really big shifts, big strategic moves that need to be made. But then once that has taken place, there's this ongoing innovation, creativity process, and let me describe that for you at the moment. So because the name of the game is ongoing wealth creation, and in this episode I've laid out the challenge in that, doing it not once but ongoing, then it makes a whole lot of sense that the whole strategic management framework and approach is grounded in a capability and an understanding of value measurement, and particularly value measurement at a disaggregated level. And so there are a number of very structured things to be done to value the firm at various points in time. And that really gives you a strategic map or a roadmap of where we are in a value sense, where we're creating value, where we're destroying it, and why. And that has a very important feed in to the whole strategic planning process. So there is an important amount of work and activity to be done in the realms of value measurement. And in a lot of ways, the finance group within most organizations would probably have the domain around doing or facilitating the value measurement. It's the numbers side of the corporate management process. Okay, that's important, but the name of the game is wealth creation. And so these blue ribbon activities, again, there is a structured and systematic approach to wealth creation. But let me just tell you this, is that it is fundamentally dominated in creativity and innovation and thinking about possibilities and developing value propositions and then rounding those out and sort of putting them together in terms of alternative strategies, and then valuing those alternative strategies to convince yourself that the new ideas, the new products and services, the new distribution models, the new segments, the new ways of serving customers and clients will add value to the business, because if it does, that's how wealth gets created. And then, of course, what you need to do is you need to commit to actually executing it, because no strategy unexecuted is a good strategy at all. And so then in these orange activities, it's all about value realization. And so I'm in Australia, so we spell things with an S, not a Z. So just for those that are in North America and elsewhere, that's what's going on here. So it is all about a structured, systematic approach to strategic planning. And again, but it's a value-based strategic planning process. There is a structured and systematic approach to strategy-based resource allocation, which is fundamentally different to mainstream budgeting, command and control, top-down target setting. Later, I'm going to talk about the dysfunctional aspects of traditional the finance department's approach to, the CFO's traditional approach to target setting, budgeting. It's so denuded and devoid of the real drivers of wealth creation, which is creativity and innovation. Okay, I'm just going to be really blunt about that. There is then a target setting and a budgeting process which is subservient to the strategy process, not the other way around. Yes, you need to manage performance and managing the performance in line with the strategy that has been committed to, which, unless you manage the performance of the strategy, then the value of the firm built around that strategy is not a real value. And then the last thing is executive reward, which is an appropriate reflection in remuneration to the executive team for doing what they are fundamentally hired to do. Now, sometime in the future, I'm going to do a whole podcast episode on executive reward, because, excuse the French, by and large, out there, in the corporate world, executive reward is a real shit show. And it is so destructive. It is doing everything. It is doing everything, either deliberately or by consequence, to work against everything that needs to happen. And so executive reward and fixing it is really important. Okay, so these are all the sort of, the harder, mainstream elements of corporate management. But the other important thing is that there is a lot of work that needs to be done in 99.9% of the large corporations around the world around culture, people, culture, leadership, systems and processes. And the HR department, or groups within most corporations, in my view, as much as they are working as best as they can, they really have an opportunity to really step up to the plate, because at the end of the day, ongoing wealth creation is a human endeavor. Creativity and innovation is a human endeavor. And so there's a lot of work to be done at the human level, both at the individual level, so individual people, but then teams, and how those teams then, the teams of teams that work together. And so, it is really important that from the boardroom down to the shop floor, there is a deeply ingrained understanding of the purpose of the corporation. Why are we in business? And increasingly, that purpose is going to be described in terms of a noble intent to enhance the well-being of the individual, wider community, and the environment. We then need to build a culture that is aligned to that purpose and intent. And there is a lot of work to be done in terms of individual leadership capabilities, but then team-based capabilities. There's a reasonable chunk of work to be done around organizational structures and processes, because at the moment, a lot of structures and processes suck the living life out of the people that are the fundamental asset in the organization. And then, yes, there's a lot of opportunity to then harness technology, digital transformation, and the use of data. Just as an aside, I recently had the opportunity to observe an organization that was undertaking a very, very large-scale digital transformation process ahead of defining, ahead of all of these fundamental things. And so it's like they're digitally transforming the organization, but blind of the kinds of things that digital transformation is required to achieve from an objective sense. So I just thought that was a little bit, the cart before the horse. There is a structured approach to doing this that I just, I can't say it often enough, to be honest. So last slide before I sort of, end off on the slide. I just want to lay out the idea that beyond the real fundamental sort of seismic shift transformation elements, which again also has a very structured approach. Actually, let me go back. A lot of this activity here, which is the fundamental engine room for ongoing systematic transformation, is performed at a disaggregated level, right? And so, a lot of the large consulting firms, McKinsey, Bain, BCG, back in the day, they used to do a lot of really, seismic corporate strategy work, which is really great. It's really important work to be done. But then the real hard work gets done at a disaggregated, at a segment level. And so the strategy game here is that you need to understand where you're strategically positioned at a segment or a disaggregated level. And so that's what this matrix is here. It's a fairly simple framework to strategically characterize parts of the business in terms of, participating in attractive markets with a form of competitive advantage or disadvantage, as the case may be. And then from that strategic characterization, understand the economics of the business in terms of the economic profitability and the amount of capital invested in various parts of the business. And so the wealth creation game is to make the green bits of the business bigger, and even the orange bit here, the orange bit is sort of fairly marginal, or actually I should say, or making the red parts of the business, the economically unprofitable parts of the business, less economically unprofitable. And so that's the name of that game. So as we slowly wind down, what I was describing here, other than the recap from the previous two episodes, is the kinds of work and activity that boards and CEOs and senior executive teams need to engage themselves in order to create wealth on an ongoing basis. And then later, I'm going to bring into the conversation the other tier, which is and doing it in ways that enhance the well-being of the individual, wider community environment. There's a lot to talk about that aspect as well. But here I was just really talking about the kinds of capabilities, organizational capabilities, that pretty much every corporation around the world, certainly the listed corporations, but this same systematic approach to ongoing wealth creation can easily be deployed in private companies. The only difference between a listed company and a private company in this sense is that in the private companies, there's not a share price to reflect value. And in a lot of ways, that's actually a benefit because in my view, the capital markets at the moment are not serving, their purpose very well at all. And so the share price and being fixated on the share price and the ebbs and flows of the share price that just flick around, probably more to do with supply and demand and the supply of money that finds its way into the capital markets, which is another problem that I'm going to talk about down the track. We need to fix this. These machinations have more to do with supply, demand, than anything fundamental. And so it's a real distraction to boards and senior executives when they look at share prices and try and second guess strategy to drive share prices even higher. It's a fool's errand. Please don't go down that path. There is a much better approach. We're going to talk about it in layers, right? Because these topics, they're so broad-based and so the understanding, the ideas are so fundamentally different that we just need to lay it out in just small little incremental layers. And so thanks for tuning in. Please like, share, subscribe, comment, both on LinkedIn and on YouTube. The more you subscribe, the easier the algorithms allow other people to find the YouTube channel. And so the message just gets out there. I'm not looking for subscribers to monetize this channel. I'm not going to monetize this at all. I hate advertising on important YouTube content. So it's not about monetization. It's about getting the message out. So the more you propagate the message amongst your peer group and influence group, the easier and the quicker, in fact, we can get going on the really hard work to transform the global business and investment communities to create wealth on an ongoing basis in ways that enhance the well-being of the individual, wider community, and the environment. Thanks for tuning in. Look forward to seeing you next time. Please stay tuned, keep up to date, and bye for now.